Hey there, YouTube. So welcome back. This week, the market finally retreated. Where's it headed next? We're going to get into Tesla and see, is it worth the buy? And then finally, we'll get into some put sales and we'll go into a money study and how people are feeling about money. So let's jump in. As always, this is not financial advice. The government's still shut down, so we are not really getting much for economic news. We did have the release of the FOMC minutes. That's the Fed meeting 3 weeks ago, and then the Michigan consumer sentiment, we got that, and that came in line pretty much with consensus 54.2, 55. It's just people are feeling okay. So let's jump into your questions. So what are your thoughts on the recent noise around the index fund bubble? As the bogglehead investor community continues to grow, there's been an increasing amount of fear and theories of how oversaturation of indices is dangerous for the market. Is this just active fund manager propaganda? I think it is. John Bogglehead, and he's a long-term buy and hold, set it and forget it. An index fund is really just a bunch of stocks that are put together, and then really there's no management of it. There's no rebalancing. It's just these are the companies within that index. Whereas an active fund is managed and there's constant rebalancing, maybe every quarter, every 6 months, once a year. There's moving in and out of stocks and rebalancing. And you're trying to get the highest return for the least amount of risk. That's where the active manager comes in. They charge a fee for that. And if you look, the active fund has somewhere in between 0.5% and 1% yearly expense ratio, which can be expensive and really eating your returns. Whereas John Bogglehead believes just go buy a passive fund like an S&P index fund, and there's very little management. And really, at the end of the day, if you were just tracking the index, if you look at it over time, it is always outperformed, and it's very difficult for an active fund manager to try and keep up with the market, or let alone pass it. Sometimes they will, and sometimes they do, but it's not often. So sometimes it's just better. If you're a passive investor, just buy and hold, set it and forget it. Dollar cost average in, great way to go. But yeah, I do think it's a little bit of propaganda. Can you please make more videos? Sure. Also, if you can include Tesla and the Magnificent Seven, thank you. The Magnificent Seven, really, all that is, there are 7 main stocks. They're at the bottom of your screen. They make up 30% of the S&P, and this is the sort of the danger with the Mag 7 when you hear about the Mag 7. Let's look at how the Mag 7 has performed against the overall market. So there's the Mag 7. This is going back to April of 2023. The Mag 7 has performed at 150% return, more than doubled since April of 2023. Whereas the S&P is only 60%. The dangerous part of that is these 7 are in the S&P, but 30% of the S&P is made up of these 7. Since this is very tech heavy, a lot of it's been AI driven over the last several years. If that is a bubble and that collapses, you're going to see the S&P crater as well. The S&P is not as diversified as it used to be because of the Mag 7. Let's jump into Tesla. So how does Tesla make money? There are really 3 revenue streams. Their business model consists of making autos, energy generation and storage, and then they also do service. So think of older Teslas that are no longer in warranty. That's part of their business as well. So 80% of their company, though, is made up of auto sales. And then you can see the percentages over here. There's a little over 6% in energy generation and storage, 8% in services, which is taking care of the cars, parts, things like that. So when you look at overall where Tesla's at, this is back in 2023, their top line revenue is $96.7 billion with net income of $15 billion. When you look at how a company makes money, you've got top line revenue, you've got cost of goods sold, and then you've got your gross profit or your gross margin. Let's take a look at gross margin for Tesla. And I broke it down by their 3 revenue centers: auto, energy, and services. Services, we'll look at auto in just a second. There's services, there's your gross margin. So when you take out the cost of goods sold and you look at the top line revenue, subtract the cost of goods sold, what is their gross, basically their gross profit, but in terms of percentage, you can see it on the services side, they're not making a whole lot of money. They're 6-7%. Look at energy. Now there's some healthy margins, 25 to 30%. The only way you can really increase gross margin is either increase the top line sales without increasing cost of goods sold, or decrease cost of goods sold, which is what it takes to produce and make whatever it is you're selling. Then you look at automotive. Now, since 80% of their business is in auto, you're thinking 20%, but look, it's declining. If you look over time, let's see if I can highlight this purple. There it is, 14 in Q1, 14%. And something happened in Q3 of 2024, and then it starts declining again. And you get all the way down to this last quarter, and your gross margin, gross profit, that gross margin percentage is only 17.7, and it's been declining. That kind of makes sense. Now let's look at their operating margin. So take that top line gross profit and let's subtract SG&A. This is your compensation, marketing, the cost of selling. That's your earnings before interest and taxes. So looking at the operating margin, we were at 17% for gross margin, subtract all the company overhead. Now we're only 4%. So we are only keeping 4% of all the sales that we have. We're only keeping 4%. So it's not a huge moneymaker. We have at that 96 billion, only 4 billion or so is profit after you subtract everything else with all the overhead. Now let's look at the other auto manufacturers, see how Tesla compares with them, and we'll figure out whether Tesla's a good buy or not. I've added in Ford, GM, and Toyota. So this yellow, bright yellow one is Tesla, and this is Toyota. This one is GM, and this one is Ford. So now we're taking the same exact operating margin, that ratio, and we're looking at other companies to see how it performs against its peers, to see if it's worth it or not. And you can see that Ford has a 1% operating margin. So after they pay everything from cost of goods sold, pay all the employees, marketing, and everything else, they're only making 1%. And that's before interest and taxes. So not a real good one with Ford. So I would stay away from Ford. Tesla, 4%, GM, right around 4%. Look at Tesla, though. Over time, it's been falling, whereas GM has stayed pretty flat. And then look at Toyota. Their operating efficiency is pretty good, 9.52%. Let's look at one more valuation metric called price to earnings. All right, so here is the price to earnings ratios for Ford, GM, and Toyota. And then we'll jump into Tesla here in a second. You can see that the price to earnings ratio is right around 8, 8.7, 8.5, and then up to 14 for Ford. The way to think about price to earnings ratio is if I have $1 million company and I'm looking at selling it, I'm probably going to sell it somewhere around 2.5 to 3 million. So it's a 2.5 to 3 PE ratio. So I bought that company, buy it for 3 million. It's going to take me 3 years to get my money back, right? I went out as an investor, bought it. It makes $1 million a year. I'm going to buy it for 3. It's going to take 3 years for me to recoup my money. The more income a company makes, let's say you're making 5 million a year or 10 million a year, your PE ratio, that multiple, expands. And so if you have a company that's making 10 million a year, you can probably guess you're going to get somewhere around 5x. So you can sell it for $50 million. Companies out on the S&P are the same way. Their PE ratios are typically between 15 and 20x. So going back to that 1 million, if you could buy a company for 1 million on the S&P, you'd buy for 1 million. It makes 1 million. You could sell it for 15 to 20 million dollars. All right, that's on average. So if you look at GM, Ford, and Toyota, their PE ratios are 8.5 to 14. That means if I could buy all of GM, it would take me 8 years to make my money back. That is just another way to look at it. Think of PE ratio as almost in years of getting your money back. Now let's take a look at Tesla and let's see how it compares. There's Tesla. Take a look at that, a 240 PE ratio, 240. So if you were to really look at that, it would take you 240 years to get your return from what Tesla makes. The thing is, people are valuing Tesla so high because they're not looking at it as a car company, they're looking at it as a tech company. But we just saw a minute ago, when you look at their revenue streams, 80% of it is just a car company. And then they have battery storage, energy generation, and it's not that much. It's only 6%. And then they have services, which is 8%. So I don't see how this can be valued so high. That means the price at $450 is 250 times what they're making. If you were to divide that, let's just say let's just say it was 20 times. That would put Tesla sub $100 a share, because right now it's $450 a share. You do this kind of evaluation, you're looking at sub 100. Now, there's probably a lot of people out there, a lot of haters that might look at that and say, you are out of your mind. Tesla's worth what it is. From a fundamental perspective, it isn't, especially if you look at them as a car company, just like GM and Ford. GM and Ford have been around 100 years. When Tesla's been around 100 years, you think they're going to still be commanding a 250 PE? Take 230, 40 years to get my money back? Now, if I go buy the stock, there's a thing called speculation, and that's what that's made up of. So that $450, sure, you can go buy it. It might be $500 next week. It doesn't mean it's worth it. It's worth whatever somebody's willing to pay for it. I'm talking strictly fundamentally. It is a car company. Therefore, I don't think it's worth $450. I have shorted Tesla. In fact, I did when it was $450. I shorted it and it worked out okay. But be careful with Tesla. You can go out and buy the stock and it could definitely go up. It could tank. Look at GameStop a couple years ago. GameStop was only worth $2 or $3 a share and it went to $480. Somebody thought it was worth $480 a share when it went through and we had that little craze. Doesn't mean it was worth $480 a share. At the end of the day, it's still only worth $3. So Tesla should be sub 100. All right, enough about Tesla. So here's what's coming up. With the government shutdown, we're not getting much. We should have been getting CPI, PPI, retail sales, all that should be coming out, and we're getting nothing. All we have is the Fed Chair Jerome Powell's speech, which we already know where he's at. He's not giving any clues if there's going to be another rate cut. And then we will have the Fed meeting coming up very soon. But as far as economic data, there's not much. Finally, the market retreated. I've been waiting for this. We talked about, I'm waiting for a 2 or 3% pullback. Man, it did it in one day. That was a pretty interesting day. Trump came out and slapped China, didn't like something they were doing, and they decided to slap them with 100% tariffs on top of what they're already, on top of tariffs that are already in place. I was going to say what on top of what they're already paying. It's really us that pays it because it's a tax on us, not on China. Look at earnings, 293.87. Call it flat from week over week, but with that drop, we're now at 22 PE ratio. Now you know what that means. 22 years to, if I were to buy all the S&P, it'd take 22 years to get my earnings back. Friday morning, it was quiet. And then it fell 3.5% when you include after hours on Friday afternoon. So who knows where it's going to open up Monday. It's going to be an interesting week. I don't think it's going to crater like it did in April. It will probably open up in the red, but we will see how far down it goes. SPX for the week, negative 2.52. IWM, which is your small caps. This is the one I've been waiting for because I'm looking at buying them. IWM went up. I was able to close my positions because my puts pretty much were worthless. When it came back in on Friday afternoon, I went ahead and sold some more puts at 235 on IWM, and I will see how far it goes. If I decide to add to the position, if it continues to go further down, then I will maybe add at 225. I don't know if it'll go down that much, but the good thing is now it's presented some good buying opportunities. So with it being mid-October and we know the end of the year typically is a good time of the year, I think it'd probably be okay to start adding, but I will be very cautious how I add. I want to see how this news is going to make everything play out. XHB, your housing stocks fell 8%. Man, every day I was looking at it and it was down another 2%, down another 2%, down another 2%. Housing took a bath. So we're down to now 103. I do have some 104 puts. I said I was going to sell some 104 puts so that I can get into it. We'll see how far down it goes. It's had a 10% correction already within housing. But I think as interest rates start coming down, housing is going to perform well. AG&C, one of my faves, down 1%. Data centers, flat. TLT, great week, 20-year bonds. Everybody freaked out and everybody ran to safety. That's what they're going to do. They're going to go into bonds. And that's all your 20s and 30s. So that everybody bought bonds, and TLT, I'd been straddling that. And wouldn't you know that Friday it was 100% profitable. It was dead center, had no time value left. My TLT position had calls at $90.50. Because TLT moved so much, it went to that 90.50 and I ended up closing it out at a break even. So the profit that I had made for the week by straddling it, I didn't lose anything, but I didn't make anything. I couldn't close it out because there was no price in them. So there was no buyer for me to sell it to. But then all of a sudden it jumped up to $90.62, I think is what it closed at. So I just broke even on that one. It'll probably retreat a little bit after this thing settles out, and then I'll keep straddling again. But TLT's been a great winner for me for this year. And then XLU had a good week. Put sales, I'm going to get into this in the next video. These are the companies that I did sell puts on for the week, and I will talk about that in my next video. And this is, we did make some money on this one, these plays, before the debacle happened on Friday. Some of these I ended up closing on Friday at a slight profit. Again, some of them were 100% profitable, and I couldn't make any more. And then all of a sudden, things fell like 3%. And that's how far out of the money I was. So at least I was able to get something. And this is what's coming up next week, but I'm going to talk about that in my next video. And finally, we're going to talk about the Wells Fargo 2025 money study. How are people feeling about money? Wells Fargo surveyed about 3,700 Americans and about 233 teenagers and asked how they felt about money. Things are very expensive. Let me just go through this report with you. So people are saying prices are higher than people expect. Yes, they thought going out to eat would be $23. Actual cost was $40, so 74% more than expected. Bottle of water price was 200% more than expected. 90% of people feel sticker shock in at least one area, 76% in eating out, 63% a tank of gas. This one is just normal for me. To me, it's not sticker shock, but sometimes eating out, what used to cost me $50 for a family of 5 now costs me well over $100 every time I take them out to dinner. So it gets expensive. I know you guys are feeling the same thing. Higher prices are pushing people to make more tough financial choices. There's an increase there. Many people are cutting back on spending. Up 76% of people are cutting back. And of those delaying important life plans, 74% of people are saying they're delaying travel. And 39% say they put off renovating their homes. 30% have put off buying a home. 20% have delayed adopting a new pet. People are feeling financial pressure. Specifically, they're feeling strapped by bills and debt. 67% say they're able to pay their bills and still have a little left over for extra. 50% say they have more debt than they feel comfortable with. I'm going to put a link in the report. It's going to go into some business stuff. Skipping down. Common financial advice is not cutting it. People are tired of hearing the same old things. 86% say they're sick of hearing at least 1 in 10 common pieces of financial advice, such as eat at home instead of eating out. Get a side hustle. Stop buying fancy drinks. And they're seeking more financial advice from others compared to last year, at the tune of 13% more. 67% of people follow at least one media source like YouTube for information, money, and finance. Thank you. 28% watching YouTube videos. So thank you very much. That's fascinating. 26% visit financial websites. 26% watch financial news or programs. And 19% listen to podcasts about personal finance, investing, and economic trends. I'm sorry, I do love economics. I wish I could get more than 19% that love economics. I find it fascinating. It helps me know how to invest. But they aren't finding the advice of well-known money and financial experts that influential. Fascinating, right? 2% said Dave Ramsey, 1% said Warren Buffett, and 1% said Sue Orman. That's fascinating, right? All right, so I'm going to put this link in the YouTube comments. I'll talk about put sales in my next video and what the opportunities are coming up there. And with that, I hope you guys have a great day and look forward to seeing you next time. Happy trading.